Good afternoon. You're watching us here on Halftime Report. I'm Mangala Malu. With me, Ekta Batra as well as Sonia Shenoy. Not looking particularly good for our markets. The sell-off continues, not just from Friday, this morning as well. The intraday chart, the Nifty, comes up for you at any given point in time. One had, bought the dip or, any sort of recovery as well. They would be sitting on losses. We're seeing a cut towards that 17,000 mark for the Nifty. For now, the 200-day moving average has supported, but who's to say how long it will continue to support given the weakness that we're seeing globally. Hi.
Hi, good afternoon, Mangalam. Afternoon, Ekta. I guess, when we talk about the Indian markets being resilient, it's just that we've not fallen as much as peers across the globe, right? I mean, if you look at it, the US markets, the S&P 500 is now down 20% this year, and our own markets have just about moved into the red. So yes, there is resilience, but there's a global tidal wave which is sort of taking all boats, and our markets are not too far behind. The mid-cap index is bearing the biggest brunt this afternoon. It's a 3% knockdown on the mid-cap index, and it just goes to show that the most vulnerable pockets are seeing some selling pressure right now.
Yes, absolutely, Sonia. And that stands true for a lot of these IT companies. So, for example, Wipro, which is now down over 40% on a year-to-date basis, TechM, HCL Tech, Infosys. And these were all of the stars in the previous year. So there's a lot coming undone in terms of the recession fears that we're facing globally. But just taking your point, there is some amount of resilience that you have to give the Indian markets credit for. And that is visible in the currency as well. So, yes, we have depreciated. Yes, we are sitting at a low for the rupee at this point in time, 81.5. We've crossed that mark. But nonetheless, it's important to point out that we've depreciated the least as compared to a lot of other currencies on a year-to-date basis. And this is at a point where we have been dealing with crude prices on elevated levels. So that has to be put into context. 9.5% depreciation for the rupee as compared to a lot of our peers which have seen greater depreciation. To take this conversation and a lot more forward, we have Ajay Srivastava, who is the CEO at Dimensions Corporate Financial Services, joining in now. Ajay, hi, welcome to the show. Well, it's a tough and rough market for us, but is it in any way an opportunity?
No, I think, let's not, the market has been good because it is responding correctly to the fundamentals. If the way it went after the federal rate hike went up, I think that was the wrong time of the market of euphoria when they should have been looking at the interest rate hike in India. So if you ask me, technically speaking, the market has done the very correct thing, responding to what economic events are taking place. So it's a healthy activity that, your market is running in tandem with fundamentals. Now, having reached a point where now India is realizing that interest rate hikes are inevitable and large ones, knowing that RBI has fallen much behind the curve at this point of time, I think you need to curb your enthusiasm to buy stocks and look at more as fixed income at the end of the day. Bottom fishing is fine up to a point, but when you're looking at a scenario where your country's central bank has fallen behind the curve on interest rate hike, the US yields are at the highest level ever, in 2-year yields are at 4.4%. Inevitably, the best opportunity will come in the debt markets now, because there the interest rates should move up and move up quite substantially, giving you a healthy return compared to being in equity where growth will be sacrificed now very clearly, consumption will be further sacrificed. So, while you look at equities and says, can we get a return? I would say this is a time for fixed income investment, not a time to bottom fish for equities.
Actually, that was my next question, Ajay, because there's so much talk. Suddenly, these target maturity debt funds have come back into action, and there's a lot of interest now in the fixed income market. As you said, there's the Bharat Bond ETF as well. So within fixed income, what is your recommendation? How should investors go about it?
See, I think, the way we have planned our portfolio, I'm not here, everybody's got different situations, but where we planned our portfolio is almost 35% of our portfolio today stands invested in investment REITs, which is giving a very healthy rate of return on a quarterly basis. They still continue to give a good return of 9% plus. I think that would be one of the good places to be in. So would perhaps be, the REITs of real estate, but much less perhaps than the investment REITs of power companies. The second thing is you need to wait patiently. You don't need to commit capital to debt funds tomorrow. You need to wait patiently for this next hike of India to go through and maybe get a clear idea as to what happens and markets to come up a little bit more on the debt side. It's too premature to lock in your money on the debt fund today because you could make a loss thanks to mark-to-market eventually next 1 week. So I would say wait patiently, let the RBI policy go through, but investment trust, REITs, etc., I think are a good place to be for the time being. And number two, I would say sincerely say that wait for a while to lock in fixed income. Don't be in a hurry because you might be victim of mark-to-market losses before the interest rates peak out.
Take that point, Ajay. So a lot of allocation to move from equity to debt is what you're recommending. But for the equity part of one's portfolio as well, do you think you would recommend a churn, maybe move out of sectors which had done well and now move into sectors which are not doing, which weren't doing well? There is some sort of, so to say, relative comfort out there. And I ask this specifically with regards to your views on the IT space, because IT has been resilient over the last few trading sessions. Weaker rupee helps them, and also the past underperformance too.
See, okay, so let me answer it differently. I think for Indian economy, the way you look at it, the segment which supply products and services to the upper echelon of India, consumer brand, I think they will be relatively less affected given what's happening compared to the economy segment. Very clearly, the consumption cuts will happen at the lowest end of the economy cycle of people, economic strata of people, compared to the top strata. So I don't think this whole upheaval will impact much of what we see, let's say, the five-star hotels. I don't think that we'll see that kind of impact coming there. Luxury product services, upper tier consumer durables, they will see less of an impact. What will happen is the people at the lower end of the consumer companies supplying to the lower end of the economic strata, those will get affected significantly more. The number two is, if you're saying where are the safe havens, I think the Indian consumer brands, which are in the category of 500 to 1,000 crores, and very good brands, they are there in the market, whether consumer durable, consumer products, etc. I think there will be a good place to be, not the 3,000, 5,000 crores, but the 500,000 crores, because given the consolidation happening in the economy, all these companies will be bought out in the next 1 to 3 years' time, and therefore you get a very healthy return. And these are good companies. You've seen some of the footwear companies, some of the retail companies have done reasonably well, and they continue to do well. Same is the QSR. QSR is a good place to hide. Their consumption may fall, but what will also happen is that the movement will take place from people spending bigger money on those kitchens, etc., the gourmet meals compared to the QSR meals. So I think QSR would be another segment where you would find relative safety in the market. The last point is, we're reaching a point where, if you ask me, contra investment, you're reaching a point where contra investment needs to be done with commodities at this point of time. Whether it is aluminium, whether it is zinc, whether it is, including steel, I think you're reaching a point where your return on capital employed will be significantly high if you invest at the bottom, almost bottom of the cycle as we are reaching, and we will reach in the next 30 to 60 days, compared to buying sectors of comfort like IT. IT, the problem is, let's say the main company like Infosys, so much supply of stock can come to you and hit you that even if the fortunes of the company are good, the FPIs can just overwhelm you with supply of stocks. So you can never make a return on it. So unless you want to keep a stock for 10 years, IT is not a good place for you to hide, because the sheer supply of stock is humongous, which comes in. You got safety in your domestic stock at the end of the day. And nothing can beat the power industry, because with the new Electricity Act, I think it will see the best returns of any industry in the next 5 years. So I think, there are places to hide, places to work, and if you don't have it, you can average down. So it's not all bad gloom and doom. I think this gives you a good opportunity. And remember the word FOMO. I think this tells you there is no FOMO.
Okay, all right, Ajay, we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's the view coming in on the equity market, that maybe it might be prudent to now look at the debt market at the fixed income space quite closely as well. We need to take a short break with the news that the markets are still reeling under pressure, recovered from the day's low. But on the other side, we'll get in touch with the company, Meghmani Organics. The company will be joining in